So, welcome back, fellow investors. We've just got news, today's Tuesday that is, that Virgin is now on the verge of collapse. Deloitte's coming out and saying that there might be some private firms that want to come and take part of it. Australia really wants no part of it at all, given that the majority of their shareholders are from international companies, and crude oil prices are in the negatives, with my local petrol station being lower than 90 cents a litre. I don't remember the last time seeing that. Now, with such uncertainty and the return on cash being at an all-time low, it's really difficult to get a solid return on the cash that we've been saving up to hopefully put in the market or on a home deposit, which has left many investors, including myself, wondering where is the best place to get my return on investment, my ROI. And for many of us who want safer investments, we have been heading towards more dividend income stocks and investments. Now, this isn't anything new because dividends in Australia are quite popular. Might I say even an expectation of shareholders, given they make around 50% of the ASX's total return. Now, when I think about dividend investing, my mind immediately goes to the voice of reason and conviction in Australia on this topic, and that is none other than the man, the myth, the legend himself, Peter Thornhill, who's recently appeared in 3 interviews I've seen and disclosed his holdings and his plans going forward and offered some rationale behind these decisions. So just for the few of you who don't know who Peter is, he's basically an avid investor for dividend income and has done so for the past few decades whilst working at many different funds. Now, if you've ever seen an interview or listened to a podcast he's in, he basically at this point in his life ignores every other factor except for the dividend income, which includes growth, which includes global diversification, which he's been challenged on multiple times, but he's gone, nope, we've got very good Australian companies that are global and are diverse and do deliver a dividend. And just to also show that he puts his money where his mouth is, him and his wife both enjoy a $400,000 dividend income per annum. It's what many of us in the FIRE community, that's Financial Independence Retire Early, try to do, including myself, and you can't help but just respect the conviction that he has behind that and how encouraging and motivating that is for many of us who want to achieve the same goal. But before we proceed, I want to give a short definition of what a LIC or a LIC is, which is what Peter says that he solely just invests in now. So basically, a LIC is a listed investor company. It's a company that's listed on the stock exchange, and its goal is to invest your money into a broad fund. Now, each LIC has a different philosophy and a different purpose and also a different management expense. So we'll go through some of those things today, and I want to touch on a few of the metrics that we're going to do so to make sure that we give each one of the ones that he speaks about even exposure. So in looking over all of these LICs, there's a couple of things I want to cover. Firstly, the philosophy of the LIC, the price and market cap, the MER, which is the management expense ratio, the asset holdings, so what they're exposed to, net profit, total dividend payout for that year, dividend yield for the year, cash reserves, which helps show us how the company is going to smooth things out during times like this where there's a lot of volatility. Now, in the first look, I'm going to go through this one quite thoroughly and less so as we go on in the list, just because I want to explain how and why each metric is important. And then after we kind of look at the importance of each metric within a LIC, it's all kind of repetitive. First one off the rank is Argo, which has a market cap of $5 billion and is one of the bigger funds in Australia. They've been around since 1946, which is 74 years doing this. Now, that's a long time, guys, to be in the market and to be performing and to stay relevant for such a big fund. Because if you just think about the wars, the political changes, and any other pandemic or economic uncertainty the fund has gone through, it's survived a lot of it, and the companies that's picked along the way has survived along with it also. Now, they operate with an overall philosophy of investing in high-quality companies that can identify or have a great long-term performance at a price that represents good value, which is essentially value investing. Now, it is a rather defensive LIC, which is the words from the CEO himself, and they stay defensive to become more stable during times like this. Now, this philosophy is reflective within their portfolio when we're talking about playing safe, because 60% of their holdings is in just the largest 20 blue chip ASX companies. And they also don't really span too far in terms of holdings. They only have about 100 companies. So the other 80 companies make up the other 40% of all their asset holdings. They also come in with a very low management fee of 15 basis points. Now, to put that into context, if you invest, let's say, $100,000, with that management fee, you would only be paying $150 per year, which is extremely low when you think about all the dividends that you're collecting along the way, including the 100% franking. Now, currently, its dividend yield is at 4.58%, which is grossed up to be 6.54%, including the franking credits, which is really the actual return of the stock. What's important to note here is a solid portion of the dividends is actually reinvested into DRP, that's a dividend reinvestment plan. So basically, people who get paid dividends choose to automatically reinvest that back into the company, and the company then reissues them those shares. Now, the reason why this is good for both the company and the investor, what the company gets is it gets new capital injected into it. Capital that it would have paid out, it just gets right back into it. And for the investor, they don't have to pay a brokerage fee, and they've now acquired more shares within the LICs, increasing their shareholding position within that LIC. Now, in the 2019 annual report, it was noted that Argo actually puts a conditional order out there at a set price, so that if the stock sells at a large enough discount to the net tangible asset, or NTA, then the order would fill to buy back shares to the company, which would be nullified, which means the value for shareholders that currently still have shares would be increased. In 2019, of course, this was never executed as the markets continued to go up, but I like that they have this conditional order in place, and I'm not sure whether this is common for all listed investment companies. Now, for the 2019 financial year, Argo made a profit of $292.6 million, of which $235.5 million was paid out. But what I like most about the company is that it has $219 million in cash, not including cash equivalents, just straight cash. Now, the cash comes from many sources, like I mentioned before, that DRIP, that DRP, it comes back from that. It also comes back from retaining some profits, and it also comes in the form of share purchase plans, which the other LICs also have annually. Now, the reason why I like a big fat cash reserve is that, for times like this, when things are stressful, when we're not sure whether we're going to be getting our dividends, especially if you're heading towards becoming a retiree and relying on these dividends, is that the LICs can actually smooth out the dividend payouts, especially with franking credits along the way also. So given the dividend payout in 2019 and their cash reserves, it would seem like, they could almost pretty much pay another set of dividends again the following year, almost at the same level, if all 100 holdings failed to produce any form of dividend at all. So based on the annual report that I've seen from Argo and the numbers, I'm really liking this listed investment company, and it's definitely one of the ones that I would consider investing in. So on to the next one, we have Whitefield, another favorite of Peter Thornhill. Now, Whitefield is a smaller one with $406 million in market cap and a share price of $4.37. Now, they've been around since 1923, so that's 97 years, that's a long ass. The main philosophy behind Whitefield's investment is basically they focus only on industrials, which, if you've watched any of Peter's interviews, is what he loves, as opposed to investing in resource sectors, which can be quite volatile because they are cyclical in nature. And so sometimes you're going to have your ups, sometimes you're going to have your downs. So by avoiding those resource stocks, we just eliminate that cyclical volatility. If anything was to happen to, oil or coal mining or anything like that, that's nullified and taken out of the picture. For this though, they do charge a relatively hefty management fee of 40 basis points. And still, remember, it's relatively small. Like if you invested $100,000, it's a management fee of $400 per year. In saying that though, management fees is one of the things that we can control as an investor. We can't control how well these LICs perform as much as you can pick or try to pick a very good one. So what I'm liking about Whitefield is that it's quite diverse across many sectors, and as always, we've got to be heavy in the finance side. But look at the spread in healthcare, in consumer staples, tech, and real estate. But if we look at the individual holdings that are just 5% or over, basically all finance. And we're talking about all the top banks in particular. And so depending on whether you see the big banks growing or whether you see, a good future for them, you might not want to reconsider Whitefield as well. But remember, they're doing this to compensate taking out the resource sector as well, which is a huge part of the Australian market. Now, in the last financial year, they made $13 million in net profit and paid out $8 million of that $13 million. Their dividend yield is at 4.61%, grossed up to be 6.59%, and the cash equivalents they hold in reserve is about $6 million. So just based off this, I'm not sure if I'm really feeling Whitefield. I get it that they remove all the resources. I might give Whitefield a skip, but if you have invested in Whitefield, let me know in the comments below and let me know your thoughts about Whitefield. There might be something that I'm totally missing that I'm not too wary of at all. Always here to learn from others as well, so please don't be afraid to put the comments down below on why you're bullish on Whitefield and why you have invested in Whitefield. So guys, if you're enjoying this content so far and if you've learned something along the way, I definitely have, looking into some of these reports, give me a thumbs up. It does really help out the channel and it helps the video reach other people out there as well. So the third one Peter Thornhill talks a fair bit about is Milton. Now this one I've heard of before, it's quite popular, and its share price comes in at $3.81 with a market cappuccino of $2.56 billion. Now Milton's been around since 1938, which is about 82 years, and they don't really have a specific philosophy. They're not really defensive like Argo, they don't really take out resources like Whitefield. They're just looking to increase franking credits and increase the dividend stream for investors over time, and I guess that's what all LICs are intended to do. But what I do like about them, just like Argo, is that they have a low expense ratio of 14 basis points. Now in the 2019 financial year, they made $147.7 million in net profit and paid out $143 million of that. Their dividend yield is 4.97%, grossed up to be 7.1%. And in terms of cash holdings, they have $110 million in cash and cash equivalents. So it seems like to be the trend for a lot of these older LICs to be holding a cash reserves that's just below the annual dividend paid out that they've paid out for that previous financial year, which is good. I'm actually really learning a lot about LICs, and I can see why Peter Thornhill highly recommends it during times of volatility. And just, you don't want to be thinking about whether you're going to be receiving a consistent paycheck, I guess, when you're retiring, right? And if you can pay and a small expense ratio to have all these things taken care of, why wouldn't you? Now, I've never heard about this fund, so I had to look it up. It's a relatively new fund, founded in 2003, and its share price at the moment is at $1.31 with a market cap of $963.52 million. Now, what I found interesting was that when I went on their website, one thing that was advertised was that it was 10 basis points in terms of a management expense ratio, but then when I went and looked at their annual report, for the previous financial year, it was actually 17 basis points. So slight difference there. I'm not too sure which one they're operating on. Still relatively low. Now, BKI is much more heavily in the finance space as opposed to the other three LICs that we've touched on before. But you know what? I'll leave that up to you, whether you feel iffy about the whole finance sector in Australia. I know some people are just like really against the banks and whatnot. I honestly don't care as long as they keep paying dividends. And I must say, I think they've gotten a little bit better and have learned things from 2008, 2009. Now, in the 2019 financial year, they made $74.7 million in net profit, paid out $64 million of that. They have a dividend yield of 5.54%, which is grossed up to be 7.9%. Now that's much higher than the other three. But in saying that, take this into consideration that they are heavy in the finance space, which do pay out a higher dividend. So take 7.9% grossed up, with a grain of salt. And in terms of cash and cash equivalents, they are holding $88.8 million, which would pay for another year's worth of dividend payouts. Good stuff, BKI. So basically, those are the 4 LICs that Peter says he's going to hold on to, essentially for the rest of retirement, that he doesn't want to think about, that he just wants to put his money into that and let it do its thing. And I know this is more of the old tried and true, but if you are taking the approach in investing in either an ETF or a LIC, just make sure you do it consistently over time. What might seem small at the very beginning, because you've only invested maybe, $100,000 is big, but let's take that for example. Let's say you've put in $100,000 and you only might be receiving $4,000, $5,000, $6,000 in return for all your efforts. Over time, that starts to compound and get bigger. Once you get to 200,000, it starts to become 10 to 12,000, 300,000. It keeps adding up. Once you get to $1 million, then you start replacing a portion of your income. Like, you actually have reached fire. You're now financially independent. You don't have to go to work. Which is the reason why Peter, you will never see him quiver away, kind of entertain any other thoughts or anything like that, because when you're receiving a cash flow of $400,000 plus, that's a really powerful thing, and that kind of gives you the FU money to tell other people where to go. And in this instance, he does. When other people pitch different ideas at him, he doesn't actually say it. He knows what his plan is. He knows what the approach is through his many decades of investing, and he's stuck to that tried and true. And you have to respect that. I absolutely respect that. And it's such an awesome thing to see somebody his age having such enthusiasm about life and just wanting to live his fullest self instead of worrying about the fluctuations and the volatility in the market. But anyways, guys, that's all from me. I'll catch you guys later. Again, these lights are really hot. There's no AC in this room, so I'm sweating right now. Catch ya. Cheers.